There is a Canadian company generating $3.14 billion in annual revenue. It operates across the United States and Canada. You have almost certainly been inside one of its locations, or at least driven past one. And the overwhelming majority of Canadian investors have never looked up the ticker. The company is Boyd Group Services. It operates collision repair shops under names like Boyd Autobody, Gerber Collision and Glass, and Assured Automotive. It is one of the largest collision repair networks in North America. And it has built that network through 20 years of disciplined, quiet acquisition, buying independent and small chain shops, integrating them into its operating system, and growing revenue through a model that most investors have never thought to look at. This is not an anomaly. The TSX is full of companies like Boyd, businesses compounding quietly in sectors that sound boring, in industries that generate no financial media conversation, under names that most retail investors have never searched. A trucking company that just reported 39% net income growth in Q2 2026. A steel distributor that just posted record revenue of $1.7 billion. Shares jumping 10.5% in a single day. And almost nobody watching. An engineering firm with $6.5 billion in annual revenue, 17.6% EBITDA margins, and an 8.8% average annual dividend growth rate over a decade. That almost never appears in Canadian dividend content. And a remote aviation company, one that flies into communities with no roads under government contracts, that published record results this morning with an all-time low payout ratio and another dividend increase. 5 companies, 5 sectors. One question: why does almost nobody talk about them? The Boyd Group, Inc. is one of the largest operators of non-franchised collision repair centers in North America in terms of number of locations and sales. Boyd operates locations in Canada under the trade names Boyd Autobody and Glass and Assured Automotive, as well as in the U.S. under the trade name Gerber Collision and Glass. The word non-franchised is important. Boyd does not sell franchises. It owns and operates its collision shops directly, which means quality control, training standards, and insurance network relationships are maintained consistently across every location. The economic moat most investors miss. Collision repair is not like most consumer services businesses. When a car is damaged in an accident, the insurance company pays, not the driver, the insurance company. And insurance companies do not send their policyholders to random shops. They maintain approved repair networks, lists of shops that meet their standards for quality, turnaround time, and pricing. Getting onto an insurer's approved list requires meeting operational standards that take years to establish. Boyd, with hundreds of locations meeting those standards, is embedded as an approved network partner for major Canadian and U.S. insurers. This means Boyd's revenue does not go away in a recession. Cars get damaged regardless of the economy. Insurers keep paying. The approved network keeps getting referrals. The collision repair business is structurally more recession-resistant than it appears. Q1 2026. Boyd Group Services. TSE BYD reported record first-quarter revenue and adjusted EBITDA, helped by the January acquisition of Joe Hudson's Collision Center. Ongoing cost savings initiatives. The serial acquisition model. Boyd's growth playbook is to identify independent or small-chain collision shops in underserved markets, acquire them, integrate them into the Boyd or Gerber network, and achieve scale efficiencies through centralized procurement, training, and insurance relationships. In 2025, Boyd Group Services' revenue was $3.14 billion, an increase of 2.36% compared to the previous year's $3.07 billion. Why nobody talks about it. Car repair shops does not generate financial media excitement. The business sounds fragmented, low-tech, and geographically scattered. Most retail investors have never connected the familiar shop name to a publicly traded serial acquirer compounding over decades. The honest risk: earnings declined 24.95% in 2025 despite revenue growth. Margin pressure from labor costs and material inflation is real. The company carries meaningful acquisition debt. Investors should monitor EBITDA margin recovery, not just top-line revenue growth. TFI International is a North American transportation and logistics leader, operating across the U.S., Canada, and Mexico through wholly owned subsidiaries in three segments: less than truckload, truckload, and logistics. More than 70% of revenue comes from the United States. Q2 2026 results. TFI International Inc. reported Q2 2026 net income of $136.2 million, up 39% from $98.2 million in Q2 2025. Operating profit increased 29% to $220.4 million. Diluted earnings per share rose 41% to $1.65 from $1.17. Free cash flow reached $202.1 million in Q2, up 11% year-over-year. The company's reportable segments performed as follows. Less than truckload operating income of $85.8 million increased 17% from $73.6 million. Truckload operating income of $105.8 million increased 50% from $70.6 million. And logistics operating income of $49.7 million increased 32% from $37.7 million. Every single segment growing double digits simultaneously. The recovery from the 2024 to 2025 freight market downturn is translating directly to earnings, and TFI's management has been buying underperforming trucking companies during the weak cycle, setting up for exactly this kind of earnings acceleration. The dividend. On June 15, 2026, the Board of Directors of TFI declared a quarterly dividend of 47 cents per share paid on July 15, 2026, a 4% increase over the quarterly dividend of 45 cents per share declared in Q2 2025. The annualized dividend represents 19.7% of the trailing 12-month free cash flow. 19.7% of free cash flow as a dividend, sustainable by almost any measure. The 4% increase follows a 13% increase announced in October 2024. The management playbook, TFI, creates value by identifying trucking and logistics operations that are underperforming relative to their asset base, acquiring them, applying operational discipline, improving margins, and then doing it again. CEO Alan Baydar has been executing this playbook for decades. The quality of the acquisition analysis and integration execution distinguishes TFI from pure-play trucking operators. Why nobody talks about it? Trucking company implies commodity economics, no pricing power, and pure economic sensitivity. TFI is not a trucking company in the commodity sense. It is a management and capital allocation engine that happens to operate in the trucking sector. The honest risk: trucking is highly cyclical. 2025 was a difficult year. Revenue and earnings declined meaningfully. A CEO transition is underway. TFI is not a defensive business. It is a high-quality cyclical that rewards investors who understand the cycle and buy during the troughs. Russell Metals Inc. engages in the distribution of steel and other metal products in Canada and the United States. The company operates through metals service centers, energy field stores, and steel distributors segments. It is Canada's largest metals distributor, buying steel from mills, storing it, processing it to customer specifications, cutting, forming, splitting, and distributing it to manufacturers, construction companies, and energy industry customers. Q2 2026, published August 6, 2026. Record quarterly revenues and shipments. Revenues of $1.7 billion and adjusted EBITDA of $154 million. Gross margins improved by 130 basis points in Q2 26 versus Q1 26. Higher revenues and EBITDA contributions from Kloeckner acquisition. Annualized return on capital of 24% in Q2 26 and 23% for year-to-date. Strong capital structure. Liquidity of $554 million. Russel Metals reported stronger than expected second quarter 2026 results, with earnings of $1.43 per share and revenue of $1.66 billion, both above Wall Street forecasts. The company beat estimates by 36 cents per share on earnings and by $180 million on sales. Shares rose 10.51% to $77.63 in after-hours trading. 10.5% share jump on Q2 results. Beat estimates by $180 million on sales. Record quarterly revenue. Record quarterly EBITDA. An annualized return on capital of 24%. And virtually nobody in Canadian retail investing was positioned for it, because Russel Metals does not appear in most people's portfolios or research lists. The Kloeckner acquisition. In January 2026, Russel closed the acquisition of 7 U.S. steel service centers from Kloeckner Metals Corporation. This increase is the fourth consecutive year, with a dividend increase, and represents a 16% cumulative increase versus the dividend level in the first quarter of 2023. The dividend and buybacks. In the 2026 second quarter, we paid dividends of $24 million or 44 cents per share. We have declared our quarterly dividend of 44 cents per share payable on September 15, 2026. Since August 2022, Russel has repurchased 14% of its outstanding shares at an average of $38.13, simultaneously growing the dividend, simultaneously making acquisitions. The capital allocation across 3 channels simultaneously, dividends, buybacks, acquisitions, is disciplined and transparent. Why nobody talks about it? Steel distributor. The words trigger commodity price and risk and cyclical volatility. Both are real, but the distribution business, processing, stocking, and delivering steel to end users is a different risk profile than steel manufacturing. Russel does not make steel. It provides the distribution infrastructure that makes steel usable for manufacturers who cannot maintain the inventory themselves. The honest risk: steel is cyclical. The Kloeckner acquisition adds leverage. Q1 2026 EBITDA was $93 million. Q2 was $154 million. The business can swing significantly within a single year based on steel prices and volumes. This is a high-quality cyclical, not a defensive compounder. Stantec is a global professional services firm. Engineers, scientists, environmental consultants, architects, and project managers who design the infrastructure the world relies on. Water treatment plants, hospitals, highways, power facilities, environmental remediation, community development. If a major public or private infrastructure project is being built somewhere in North America, Australia, or the UK, there is a reasonable chance Stantec is involved in its design. 2025 full-year results. Net revenue increased 10.7% to $6.5 billion, driven by 5.0% organic growth and 3.9% acquisition growth. Adjusted EBITDA increased 16.7% year-over-year to $1,143.7 million. The company's strong project execution and cost management drove an adjusted EBITDA margin of 17.6%, achieving Stantec's 2024 to 2026 strategic plan target range of 17% to 18% 1 year earlier than anticipated. Stantec also achieved diluted earnings per share of $4.20 and adjusted EPS of $5.30, an increase of 19.9% over the prior year. 2026 guidance. Stantec expects to achieve net revenue growth of 8.5% to 11.5% in 2026, with organic net revenue growth in the mid to high single digits, driven by strong demand across all geographic reporting segments and business units. The dividend has increased by an average of 8.8% per year over the past 10 years and has been stable with no material reductions to payments. Current quarterly dividend, 24 cents Canadian per share. Payout ratio, approximately 21% of earnings. One of the most conservative payout ratios in Canadian professional services. The dividend has grown at 8.8% annually for a decade at a 21% payout ratio. There is an extraordinary runway for future growth. An 8.9% dividend increase was announced with the 2025 full-year results. The structural tailwind. Every government infrastructure spending program, Canadian federal, US IRA-related, UK post-Brexit public investment, Australian state budgets, generates demand for engineering and environmental consulting services. Stantec does not build the infrastructure, it designs it, and design fees are earned before construction begins, giving Stantec earlier and more predictable revenue than construction companies. Why nobody talks about it? Engineering consulting sounds slow, project by project, and commoditized. A $6.5 billion revenue company with 17.6% EBITDA margins suggests otherwise. The sector label, engineering services, does not generate the same investor conversation as pipeline or bank. The honest risk, CEO Gord Johnston, is retiring October 1st, 2026. He has led Stantec through a decade of extraordinary growth. Incoming CEO Susan Reisbord brings 30-plus years of industry experience, but leadership transitions at well-run companies are always watched carefully. The stock has pulled back since October 2025. Exchange Income Corporation is a diversified, acquisition-oriented company focused on two segments: aerospace and aviation and manufacturing. The aviation business is not what most Canadians think of when they hear aviation company. EIC does not compete with Air Canada or WestJet. It flies into remote communities in northern Canada, places with no roads, where the only way in or out is by air. It operates under government-contracted essential air services, providing scheduled flights, cargo, and medical evacuation (medevac) services to First Nations communities, remote resource communities, and military installations across the north. It also sells, leases, and modifies aircraft for defense customers. Q2 2026 results. Published August 11, 2026. Record second quarter revenue of $952 million, an increase of $232 million or 32% compared to the prior period. Record second quarter adjusted EBITDA of $226 million, representing growth of $49 million over the prior period or 28%. Record second quarter free cash flow of $161 million, representing growth of 30% compared to the prior period of $123 million. Payout ratio was an all-time low 65% compared to the prior period of 81%. The dividend increase announced with Q2 results. On August 11, 2026, subsequent to the end of the period, the corporation increased its monthly dividend by 4% or 12 cents per annum to $2.88 per annum. Monthly dividend rising from 23 cents to 24 cents per month. $2.88 annualized. Yield approximately 5% to 6% depending on price. Paid monthly, 12 payments per year. The growth drivers, our aerospace and aviation segment, continued to generate strong operating results due to the acquisitions of Canadian North on July 1, 2025, the acquisition of Mach 2 on January 31, 2026, strong passenger load factors across various jurisdictions, solid performance under our medevac contracts, past contract awards, and growth capital expenditures. New contracts include aircraft missionization for Air Greenland and support work on Canada's future aircrew training program. 2026 EBITDA guidance raised. Management also raised full-year 2026 adjusted EBITDA guidance to a range of $890 million to $920 million. Why nobody talks about it? Aviation company triggers the airline mental model, commodity seat pricing, fuel volatility, labor disputes, pandemic vulnerability. EIC is structurally different. Government-contracted essential air services to remote communities do not disappear in a recession. Communities in Nunavut and northern Manitoba still need to reach hospitals and supply chains regardless of economic conditions. The manufacturing segment adds diversification. The combination is highly defensible and almost completely invisible to most Canadian retail investors. The honest risk: EIC carries meaningful leverage. Acquisitions are funded with debt. The payout ratio, at an all-time low of 65%, is still elevated by industrial standards. Any disruption to government aviation contracts would materially impact earnings. The business is more complex and less transparent than a single industry company. 5 companies. 5 sectors. 1 connecting thread. All 5 are compounding in industries that sound unglamorous: collision repair, trucking, steel distribution, engineering, remote aviation. None of them appear in the top 10 dividend stock lists that circulate endlessly in Canadian financial media. None of them are discussed at dinner parties. None of them trend on financial Twitter. And yet, Boyd is generating $3.14 billion in annual revenue through a roll-up playbook that has been quietly executing for 20 years. TFI just posted 39% net income growth and a 50% jump in truckload operating income in a single quarter. Russell Metals posted record revenue and EBITDA the same week. Shares up 10.5%, while most retail investors were looking elsewhere. Stantec has grown its dividend at 8.8% annually for a decade, with a 21% payout ratio. Exchange Income published record results by every metric yesterday. The compounding is happening whether you know the ticker or not. That is the nature of quiet compounders. They do not announce themselves. They do not generate headlines. They just compound, quarter after quarter, acquisition after acquisition, dividend increase after dividend increase, while the market's attention is directed at the familiar names. The question is not whether these businesses are compounding. They demonstrably are. The question is whether you know about them before or after that compounding is fully reflected in the price. 5 Canadian companies quietly compounding in sectors that generate almost no retail investor coverage. Boyd Group, $3.14 billion in annual revenue from a collision repair roll-up that has been executing for 2 decades, protected by insurance network relationships that make it recession-resistant. TFI International, 39% net income growth in Q2 2026 from a capital allocation engine wearing a trucking company label with a sustainable 19.7% free cash flow payout on its dividend. Russell Metals, record quarterly revenue of $1.7 billion in Q2 2026, shares jumping 10.5%, with disciplined simultaneous capital return through dividends, buybacks, and value-creating acquisitions. Stantec, $6.5 billion in engineering revenue, 17.6% EBITDA margins, 8.8% annual dividend growth for a decade at a 21% payout ratio, designing the infrastructure that government spending programs are funding globally. Exchange income, record Q2 revenue, EBITDA, and free cash flow published yesterday, flying into communities that have no roads, under government contracts that do not disappear in a recession, with an all-time low payout ratio and another dividend increase. None of these are recommendations. All 5 are introductions to businesses that have been compounding quietly and will continue to, whether or not they ever appear in your newsfeed.